Hello guys, welcome to your market report for this Monday, May 14th, 2018. And let's get started. Let's open the charts right here. And the first thing we're going to look at is cryptocurrency. Bitstamp. We've been falling this morning, 83.64. Let me go to 15 minute. You can get a better look at how it's been falling. It's been as low as 82.08 at Bitstamp. Right now it's 83.60, 83.81. It's quite volatile right now, but its tendency is downwards, a downward trend. Now, if we take a look at the cryptocurrency market capitalizations here, what we're looking at is 389 billion. So we're under 400 billion. Bitcoin dominance at 36.9%. We're looking at most of the coins in the red, except for Ripple and Ethereum. Ethereum's only ever up marginally at $704. EOS is 13.56. Bitcoin Cash is 13.74. $13.56, by the way, for EOS. $137 for Litecoin, which is a good price. Litecoin's down. Now, let's see which coins. EOS is one of the ones that's substantially down, along with Bitcoin Cash. Litecoin's not substantially down. It's only down 2.86%. Tron is down quite a little bit at 4.42% down. So Tron is roughly 7 cents a piece, I guess, US dollars. Just 7.1 cents each. Neo is $64. Monero is $202. Dash is $3.99. So Dash is under $400 right now. NEM is up 10%. So NEM is probably one of the coins you wouldn't want to buy right now because it's up. Why buy something when it's up? Buy something when it's down. That's the time to buy something. But you know the funny thing about investors? They always buy things when they're up. They never buy things when they're down. Speaking about buying things when they're down, you know, silver was crushed this morning. She was smacked down. And she's bouncing right back up again. She ain't staying down. She didn't stay down. A couple hours ago, they smashed it down, and now it's bouncing right back up again. So it's up and down, you know, and it's bouncing back up to what it was before they smashed it down. So now what we're going to look at is we're going to look at the Dow Jones and see if it's become active yet. Yeah, on market open, we're up 126 points today. We're starting to head up, and we're getting up close to the upper range, which would be 25,700. We're at 24,900, so we only got about 800 more points. If it goes up 800 more points, it's going to hit resistance, the market. That's my resistance point. So we're starting to ride up to the high side toward resistance right now, you know, and I don't really expect it to make it too much over. Resistance is right around where that X is, right where I got that X. That's resistance right in there. And so it's not going to make it up too much further. It's going to start hitting resistance. So when it gets up near, it starts to head up near 26,000. It's heading up toward resistance. And so that's what's happening with the market right now. It's up 126 points on the day, though. That's pretty good considering Friday. Now, we're going to have to take a look at the bonds to see, and we're going to get to the bonds in just a minute. Let's take a look at oil first. Oil is at $70.77 for sweet light crude. Now, sweet light crude's a little bit cheaper form of oil. The other oil's probably up a couple of dollars higher, probably 72, 73. Sweet light crude is $70.77. And if we go back to a range of, say, 3 months, and let's take a look, we can see the upward trend here. I tend to think that this momentum is going to be stemmed off unless war breaks out. So as long as war is not broken out, I think the momentum is going to start to be stemmed off pretty soon because we're going to see production increases. probably in the United States. It's probably going to increase production. They're probably working at it right now, getting these wells up and running, because suddenly Canada too, the shale oil in Canada, the oil sands. It's called oil sands, is going to be more viable now that we're up into the $70 or $80 range, and they'll start pumping more. It wasn't viable back when we were down below $50 for the Canadian tar sands, because they're quite a cost to get that stuff out. U.S. Treasuries today, we're seeing it all moving up across the board. We're almost 3% on the 10-year right here, and we're seeing everything move up across the board today, except for the really short 1 month at 1.65. But now let's take a quick look at the 10-year. Let's take a little closer look at the 10-year. And we're seeing she's at 2.99%, almost 3%. Let's take a closer look at it for the 1 month chart. Come on, pull up one. There we go. We don't see much change over the last month, do we? Once it hit 3%, it passed 3%. It's been maintaining that roughly, except today it seems like it's moving upwards today, but we'll just have to wait and see if it can actually make a breakthrough. And this is what the stock market's relying upon right now. They've priced this in, see, and this is why the stock market's starting to rise again, is because they've priced in the higher bond price already. And they've gotten used to it. The buyers have come in and they've hit the bonds. And now I think this bond price is going to start to move up very soon again. It's moving up on 3-month intervals. I found out that today. The bond market is moving on 3-month interval. This means that the Fed is actually doing their quantitative tightening, like they say they're doing, because I've found evidence today that the bond market is moving on a 3-month interval. And I'm going to show you that evidence in just a minute. We're getting to it. Okay, let's get to the evidence right here. This is the evidence right here that I'm saying that the bond's moving at a 3-month interval. What we're looking at right here is we're looking at the LIBOR rate for historical LIBOR rate, 3-month LIBOR. Now, what we're going to do is we're going to focus in closer. We're going to move the chart up, and we're going to focus in much closer here. Ping. Okay, now what we see is we see the beginning of the Fed quantitative tightening program right in here, October, November, and December. You see right in here? That's the beginning of the Fed's quantitative tightening program. You see what happened? We had a marked increase with the first round of the quantitative tightening program. We've seen a marked increase in the 3-month LIBOR. And what happened here is right here at the end of December, it started to price itself in, and it kind of settled off a little bit until they raised it in January, February, and March. And then we're seeing that increase for January and February, March, which was even greater than the first one. It's because they increased it by 10 billion more. So this is the first 10 billion, then they increased it to 20 billion. See the cumulative effect, and now we see what's happened is it's leveled off again. Just like it leveled off here, it's leveling off again. It's in a 3-month cycle. It's leveling off every 3 months, and they're pricing it in every 3 months. Right? Now we're getting ready for the next 3-month punch coming up. So it was October, November, and December. That was the first 3-month punch. It's like they're punching. The second 3 months was January, February, March. And then the next one would be April, May, June. Right? So the end of June, we're at the end of this next, and then we're going to get the next punch. And so you can almost see the pattern here. So boom up, and then boom up, and then just ahead, we're almost to it. We're not quite to it yet. We're going to get the boom up, and this translates directly into the U.S. 10-year. This the 10-year is going up when these steps up, just like but it's not. The charts aren't quite showing it quite as explicitly as this chart on the LIBOR is showing more explicitly what the Fed's action. And so what we're going to see is we're going to see this 3-year LIBOR move up as well. And we're going to see the U.S. 10-year move up, and it's getting almost ready to happen. I would say by look at this chart, you can almost see how long this move inwards is that far in, and we're just probably 2 weeks away by the look of this, probably a couple weeks away from the bond yields taking off again, heading up. It's going to be devastating. When those bond yields pass 3.25% on the U.S. 10-year, and we're at 3% right now, when she passes 3.25%, then she's into dangerous territory for the stock market. And this is just going to keep going. They're just going to keep drawing this liquidity out of the system, and they think that they got the hubris to think that they can actually get away with this. But what's going to happen is it's going to seem like they're getting away with it. They're going to feel like they're getting away with it until all of a sudden the bottom drops out of the stock market. Then they're going to say, "Oh my God, we're not getting away with this." Right now, they feel like they're getting away with it because they're in all of these markets. What you're going to find is there's a delayed reaction. So you take an action, like the Fed right now is taking an action with their quantitative tightening. And there's always a delayed reaction. And so they think they're getting away with it until all of a sudden, bang, they realize that they're not getting away with it all of a sudden. And that's what's coming. And this is going to shock them. But on the other side of this, when they have to turn around and try to fix things, the mess that they've created, they're going to create the hyperinflation. So listen, thank you guys for listening. Like and subscribe, and we'll catch you in the next show. Bye-bye.